Corporate results for the Q4 2024 earnings season have been rolling in right along here the past week or so. Big bank returns marked the official start to the reporting period, although some reports did come in ahead of those big bank reports. The market had high hopes for those bank earnings. Our research director, Shiraz Mian, is here now to tell us if they came through. Shiraz, from what I saw, it looks like the big banks did not disappoint.
That's correct, Terry. Results have been extremely good. Not only the actual numbers for Q4, but even the management commentary for the coming period. So you're absolutely right. They did not disappoint.
Published reports credit a resurgence of deal making in that sector for the surge in profits that were reported. Is that how you see it?
I think that's fair. The core banking business, you would recall, has been under a lot of stress for a while now. There is a ton of regulatory burden that has been in place on them for a very long time. And then the Fed had very tight policies. The yield curve was inverted. So the demand for loan, the margins that these companies, the banks make, have been razor thin or in fact in the negative. So all the gains they got this quarter were on the deal making front. You're right, equity capital markets in which they raise capital through the stock market, not so much IPOs, but more secondary offerings. But on the debt side, there was a ton of debt issuance, and investment banking tied to that was very strong. And then the trading activity was pretty strong. Not that much advisory, the M&A activities, but most of the management teams talked up the outlook for their advisory business for the coming periods.
This year so far has had a bit of a rocky start in the S&P 500 in the market. Given that and the expensive valuations, do you think another strong overall beat is in the cards for Q4?
I believe so. I mean, we'll know for sure, Terry, after next week when we get a host of tech and industrial results. But we are on course for a very strong earnings season. The expectations for this year, for 2025, were all along very strong. And the doubters, the skeptics in the market, were looking for management teams indicating, giving us some hints that perhaps those estimates need to be brought down. We haven't seen that yet, not from the financials, which are heavily represented in the sample at this stage, but not from the others. I mean, we have a good sprinkling of results from other sectors. So I believe it's fair to say that we are on course for a strong earnings results, and that should be good for the market.
All right, let's look at the scorecard.
So, including all the results that came this morning, we now have results from 71 S&P 500 members. That's 14.2% of the index's total membership. Earnings are up 19.2%. Revenues are up 6.7%. We're talking about the 71 companies that have reported. 83.1% of these companies are beating EPS estimates, and 67.6% of these companies are beating revenue estimates. This is significantly better performance from when we look at the performance of this 71 index members across times. This is significantly better that we are seeing from this group relative to other recent periods. And a lot of that is thanks to the very strong showing from finance, as you noted, Terry. So a pretty impressive start.
What about the margins picture? What does that look like at this point?
So margins are up. What we are showing at this stage is that what we saw in late 2023 when margins turned positive continued in 2024, which is this Q4 is the last quarter of the year. So about 50 basis points improvement is expected in margin for S&P 500 companies this quarter, and we appear to be doing slightly better than that expectation. So yes, on the whole, pretty good on the margins front as well.
All right, you've written that tech is going to remain a key growth driver for earnings just for Q4 or going forward as well?
No, it's going forward as well. Tech in the post-COVID period, just taking you back a little bit, Terry, to give you some context, during COVID, tech drove the growth for the market as a whole. In fact, tech allowed us to work and operate efficiently, even while being locked in our homes. But post-COVID, there was a pretty extended period when the group really struggled in terms of earnings and revenue growth, and it turned out that all the gains the group enjoyed during COVID had essentially pulled forward or stolen the growth from the following year. So 22 was tough, 23 was tough, but 24 has proven to be gangbuster strong. We are seeing that in Q4, and that's expected to continue throughout 2025 as well. So yes, tech is a major growth driver, definitely in Q4, but the expectation is that that continues through the entirety of 25 and beyond.
So we're talking here on the 23rd of January in the new year, 2025. Last week, we saw slightly better than expected inflation data reported. Now, if the economy remains resilient, is that going to continue to support higher corporate profits as well?
Yes. A strong economy is the absolute primary driver of corporate earnings. So if you look in the context of a company's income statement, at the top is revenue, at the bottom is earnings, and the revenues part of the income statement is directly related to nominal GDP growth. And the bottom, the earnings, obviously there's expenses and inflation and margins. But you're absolutely correct, Terry. If the outlook for the economy improves, that has a direct positive effect on the outlook for earnings. Yes, that's the answer is yes. That's a net positive for corporate earnings.
All right. Well, I can't have this conversation without bringing in our new president into the picture.
Sure.
And how he might impact this whole situation. Investors were counting on a solid 2025 for U.S. corporate profits to boost stocks. The Q4 earnings season got off, as we've been saying, to a great start, but there's been analyst speculation that earnings may take a backseat to Trump's return to the White House and that slew of executive orders and policies that he's brought with him. Do you agree with that?
So yes and no. Yes, in the sense that the one thing, I mean, the good thing about our new president is that he's also the old president, old in the sense that we know how he operates. So he's always in the news, and that those headlines and tweets and the announcement he makes are not always good for the stock market. I mean, many in the market are fearful of what the tariffs will do and what the day-to-day messages he conveys about this country or that country. But on the whole, the expectation in the market is, and there is a lot of conviction in that expectation, Terry, that the thrust of his policy regime will be good for the economy, and that'll be good for earnings. So on a day-to-day basis, it's possible that the news headline he's making that day may not be to the liking of stock market, but I have no doubt in my mind that the substance of the core of his policies will be to the liking of the market and the economy. So we were talking earlier in the context of the banks and deal making, and I mentioned how the advisory business, the mergers and acquisitions business, has not been doing that good. There's not that much deal making happening. It's pretty much all of the management teams on the earnings calls mentioned that the more permissive regulatory regime that they envision will be in place under President Trump will be very beneficial for the mergers and acquisitions business. And that's just one example. So we know the regulatory regime will be pro-business, pro-growth, and that's good for the market and to improve corporate earnings.
I'm going to throw this one at you because it just came to my mind. And when you get to be my age, you have to just say things that come to your mind sometimes. Along the same lines of the new Trump administration, do you think that we're going to begin to see a more conservative corporate guidance bias because of him?
That's a tough question, Terry. I'm not sure. I think, and at least I expect, that the tone of corporate guidance this earnings season and in the coming reporting cycles will be positive. Now, guidance, by definition, these management teams are instinctively guiding towards more conservative outlooks because you would recall they are incented to under-promise and over-deliver. Now, it's very hard for them to talk down the macro outlook when the federal government is so much pro-growth. So, irrespective of the specifics of company guidance, I think the qualitative commentary we hear from management teams across a variety of industries and sectors, even if they see some macro hurdles at present, I would envision they would be talking up that the outlook is improving or expected to improve. At least that will be in the conversations the management teams will be having with their customers, and some of them do share that. So I expect the tone will be positive.
Okay, can you put a number on earnings growth for Q4 at this point?
So it's steadily going up, Terry. As we started, the expectation was around 7.5%. You've been doing it long enough, so you know that companies typically outperform and this growth pace improves. It's currently at close to 9%, 9.1% to be precise. When all is said and done, and if the rest of this earnings season proves to be as strong as the start has been, I wouldn't be surprised if the final growth is close to 11%. So significantly higher than where we are at present.
All right. Want to remind our listeners that they can check out your written earnings commentary twice weekly on Zacks.com. On Mondays, you write the earnings preview, and on Thursdays, the earnings outlook. You may want to check that out so that you can keep up to date on the latest changes in Shiraz thinking with respect to the different issues and trends that impact the individual earnings seasons. With Shiraz Mian, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.